Selling a farm is one of the most intellectually demanding events in tax practice. Seriously, it goes so far beyond just a simple real estate closing. Okay, let's dive into this complex world and map out the tax implications. Because what looks like one single transaction is actually a minefield of different rules and classifications.
This quote right here from the source material, it absolutely nails it. It gets right to the heart of the matter. We're not just selling a piece of land. We're selling a whole collection of distinct assets. You've got the raw land, sure, but also depreciable structures, specialized equipment like tractors and combines, grain bins, maybe even livestock. And here's the kicker. Each of these components has its own playbook when it comes to taxes, and that's where all the complexity begins.
So, to get through this, here's our game plan. First, we're going to survey the minefield itself. Then, we'll pull out our map, which is IRS Form 4797, to navigate the different kinds of recapture under Sections 1245 and 1252. And finally, we'll get to the main event, the really great treatment you can get under Section 1231.
All right, let's kick things off by really framing just how intricate this whole process is. A single farm sale isn't guided by one rule, it's a whole web of interconnected tax codes.
This right here lays out the core challenge. Wow, look at all those internal revenue code sections. A single sale forces us to deal with all of them. You have Section 1231 for your main business property, 1245 and 1250 for your depreciable assets, and then you have these super specific rules like 1252 and 1255 for things like farmland conservation. The critical thing to remember is that all these different rules, they all have to come together and be reconciled on one single form, Form 4797. Think of this form as our central hub, right? It's the filter that meticulously sorts every single dollar of gain into its proper bucket: ordinary income, capital gains, and most importantly, recapture deductions.
So let's get our hands dirty with our primary tool for this journey. Form 4797, Sales of Business Property, is the absolute key to correctly characterizing every dollar from the sale.
This table gives us a fantastic high-level blueprint of how the form thinks. Notice the split. For property you've held over a year, where does a loss go? Boom, straight to Part 1 for that favorable ordinary loss treatment. But what about a gain? Now that's where it gets interesting. Depreciable property and some farmland gains have to make a pit stop in Part 3 first. Why? Because Part 3 is the recapture engine. It's designed to check if any of that gain needs to be reclassified as ordinary income before the rest can move on to greener pastures.
All right, time to pop the hood on Part 3. We're starting with the most common provision you'll see with farm assets, Section 1245, which is all about depreciation recapture.
So when we say Section 1245 property, what are we really talking about in farming? Well, its scope is incredibly broad. It's not just the obvious stuff like tractors and combines. It also covers highly specialized things like single-purpose hog confinement facilities or greenhouses. It includes storage facilities like grain bins and silos. It even includes depreciable livestock used for breeding or dairy. Basically, if you depreciated it and it's not a general-purpose building, it's probably Section 1245 property.
So how does this actually work? Well, the whole idea is that the IRS wants to claw back the tax benefit you got from all those depreciation deductions. The calculation itself is pretty straightforward. You just compare your total gain to the total depreciation you've ever taken on that asset. The recapture amount, the piece of the gain that's going to be taxed as ordinary income, is simply the smaller of those two numbers. Any gain left over after that can move on for potential capital gain treatment.
And this is a perfect illustration of what we call the Section 179 trap. It's so common. Lots of farmers use Section 179 to immediately write off the entire cost of a piece of equipment. So say you buy a tractor for $100,000 and you expense all of it in year one. Your adjusted basis is now zero. Zilch. A few years later, you sell it for $40,000. Well, since your gain is $40,000, that's the sale price minus your zero basis, and that's less than the $100,000 you depreciated, the entire $40,000 is recaptured as ordinary income. You basically created a hidden tax bill that comes due the day you sell.
Now hold on, because recapture isn't just for your tractors and equipment. It can actually apply to the land itself under a very specific rule, Section 1252.
We always think land isn't depreciable, right? Well, Section 125 is kind of the exception that proves the rule. If you took deductions for soil and water conservation expenses under Section 175, and then you turn around and sell that same farmland at a gain within 10 years, guess what? The IRS can recapture some of those deductions as ordinary income. It's just another way for them to reclaim a prior tax benefit.
And with Section 1252, Timing is absolutely everything. It's not an on or off switch. It's a sliding scale. The amount they recapture is based on an applicable percentage that goes down the longer you own the land. As you can see, if you sell within the first 5 years, 100% of those conservation deductions are on the table for recapture. But look how it phases out. By year 6, it drops to 80%, then 60% in year 7, and it keeps going down until it's completely gone after you've held the land for 10 years. This makes tracking that holding period just critical for planning.
Let's put some real numbers to this to make it stick. Imagine a farmer took $50,000 in deductions for soil conservation. Then they sell the land in the 7th year. We look at our chart. The applicable percentage for year 7 is 60%. So we do the math. 60% of that $50,000 in deductions is $30,000. That means $30,000 of the total gain is going to be treated as ordinary income. The rest of the gain can move on.
Okay, so we've navigated the recapture gauntlet in Part 3. Any remaining gains, along with any losses you might have on business property, now flow into Part I of Form 4797. And this is where we get to the main event, the highly favorable treatment under Section 1231.
And folks, Section 1231 is why people call it the best of both worlds for business property. It's fantastic. If, after you net everything together for the year, you have a net gain, it's generally treated as a long-term capital gain, which means lower tax rates. But if you have a net loss, it's treated as an ordinary loss, which is fully deductible against your other income without those pesky capital loss limits. It's a huge benefit.
But of course, it can't be that simple, right? There's always a catch. And in this case, it's a big one called the 5-year look-back rule. This rule is there to stop people from trying to game the system by timing their gains and losses in different years. Essentially, your gain this year gets recharacterized as ordinary income if you had any Section 1231 losses in the previous 5 years that you haven't already paid back.
Let's walk through this example from the source to make it crystal clear. Let's say a farmer has a $50,000 Section 1231 gain in 2025. Great, but wait, looking back, they had a $20,000 Section 1231 loss back in 2022. Because of the look-back rule, the first $20,000 of the current gain gets recaptured. It's taxed as ordinary income. Only the remaining $30,000 gets that sweet long-term capital gain treatment.
So what does this all boil down to for you as a tax professional? It comes down to these key strategic points. First, you've got to be a hawk when it comes to tracking holding periods. Second, your fair market value allocations have to be meticulous and, more importantly, defensible. Third, you have to maintain a rolling 5-year history of those Section 1231 losses. And finally, you always have to manage that constant tension between taking big deductions now and facing a big recapture bill later.
And that brings us to our final thought. The tax code never stands still. It's always changing. As the rules for things like bonus depreciation evolve and phase out, the stakes for getting these allocations and recapture calculations right are only going to get higher. So the question we want to leave you with is this: is your strategy truly ready for the recapture minefield that lies ahead?